Please like, share, and subscribe. Wishing you happiness and good luck every day.
Ever feel like the stock market has its own secret calendar, a hidden rhythm that nobody tells you about? Well, today we're going to dive into exactly that, the fascinating world of seasonal market trends. We're talking about historical patterns that seem almost too consistent to be real. And our guide for this whole thing is the deep research of analyst Jay Kaeppel. But here's the thing, it all kicks off with a story. And that story starts back in 1982, with an idea that seemed, well, completely ridiculous. An idea so far out there that the very man who would end up writing the book on it at first just called it the dumbest thing he'd ever heard. So why was this idea considered so crazy? I mean, what made it so preposterous? To really get it, you have to go back in time with me, to the absolute mess that was the market in 1982. It was a time that had basically trained investors to expect failure. Picture this. For 16 long years, the Dow Jones Industrial Average was just completely stuck in a rut. I mean, look at this timeline. Every single time it got close to that magical 1,000-point level, bam, it got brutally smacked down. A 23% plunge in '66, then a 36% bear market just wiped everybody out, and then a monster 45% crash in '73, '74. By 1982, let's just say investors were feeling pretty beaten down. This created a really simple, and let's be honest, pretty cynical investment strategy. The playbook was, you buy stocks when they were cheap, and the second the Dow even started looking at that 1,000 mark, you sold everything. That was the only game in town. It was all about survival, not about growth. So into this world of fear and skepticism, right? Imagine someone shows up with an idea based on some quirky pattern that started way, way back in 1902. It just seemed totally irrelevant, almost laughable. And yet, this was that so-called dumb idea that Jay Kaeppel happened to stumble upon. And this is where it gets really wild. What's so mind-blowing about this is the sheer consistency of this bizarre pattern. Every 20 years, like absolute clockwork, the market had gone on a massive, multi-year rally. And it always started in June of a year ending in a 2. A 50% rally, a 69% rally, 87%, 73%. I mean, the data was right there. But the question was, could something that happened 20, 40, 60, even 80 years ago actually matter now? The calendar was pointing right at June 1982. So what happened? Well, the pattern hit again, and boy did it hit hard. From June 1982 to December 1985, the Dow soared an incredible 99%. The dumbest idea ever turned out to be spectacularly right, launching one of the biggest bull markets in history and turning Kaeppel into a lifelong student of these kinds of cycles. That incredible story is our perfect entry point into the core idea we're digging into today, decoding the market's seasons. And look, this isn't about magic or anything like that. It's all about understanding these predictable calendar-based patterns. So what is market seasonality anyway? Well, it's just the theory that the market has tendencies, predictable habits that are tied to specific times on the calendar. This isn't some crystal ball thing, trying to predict the future. It's about looking at decades, sometimes more than a century, of historical data to find these patterns that just keep showing up. And this right here is the crucial point. This is the whole ballgame. Seasonal analysis doesn't get bogged down trying to explain why these patterns happen. We could guess all day. Maybe it's holiday shopping or tax season or just investor moods. But the focus is on the evidence. It's simply about observing that these things have happened consistently for a very long time. Okay, so that 20-year cycle was a big one, but it's really just the tip of the iceberg. The calendar is actually packed with these kinds of fascinating tendencies. So let's take a quick tour of some of the other really well-known trends. Honestly, researchers have found dozens of these things. There's the famous January Barometer, which we'll check out in a second. You've probably heard of the Santa Claus rally, right? That tendency for the market to pop in the last week of December. There are also really powerful trends tied to the 4-year U.S. presidential election cycle. And it gets even more granular. There are patterns for certain days of the month, and even patterns for which year of the decade it is. Like years ending in 5 tend to be really strong. Let's just grab one of those as a quick example. The January Barometer is a super simple saying that basically suggests the market's performance in January can hint at its direction for the rest of the year. If January's up, the theory goes, the year is probably going to be a good one. It's one of the oldest seasonal indicators out there. And that one little saying really captures the whole idea here. See, when a seasonal analyst looks at a calendar, they're not just seeing days and months. To them, it's a map. It's a map filled with decades of data, pointing out the times that have historically been good for investors and the times that have been, well, not so good. All right, this brings us to the big one, the one you've probably heard whispered about on Wall Street, the most famous and definitely the most debated seasonal trend of them all. You know the phrase, sell in May and go away. Let's look at the actual data. I mean, the idea itself is pretty provocative, right? Let me ask you, what if you could capture most of the market's gains by only being invested for half the year? And what if the other 6 months historically produced almost nothing? The whole theory just splits the year into clean halves. You've got the historically favorable period, which runs from November through April, and then you have the unfavorable period, which runs from May through October. The difference in how they've performed is, well, it's pretty shocking. And wow, this chart really just lays it all out, doesn't it? Historically speaking, pretty much all of the stock market's net gains have happened in that favorable November to April period. The other 6 months, May to October, have basically produced nothing. They're flat or even a little negative over the long haul. Now, people have theories. Maybe traders go on summer vacation, maybe it's portfolio rebalancing, but whatever the reason, the historical data is what's so compelling. Okay, but here's the thing. Relying on just one of these trends can be pretty risky. The real power comes when you stop looking at them one by one and you start combining them to build a much bigger, more powerful tool. How do you turn all this data from just noise into a clear signal? Here's the key insight. Think of it like this. Any single trend, like sell in May, might not work in any given year. It's just a clue, an anecdote. But when you start layering multiple independent trends on top of each other, well, now you're not just looking at a clue. You're starting to build a case. You're building a model. And the process for doing that is actually pretty logical. First, you just track a whole bunch of different trends. The January Barometer, the election cycle, all those monthly patterns. Then, on any given day, you just see what each trend is signaling. Is it positive? Is it negative? And finally, you just add up all those scores to create one single master indicator, what Kaeppel calls an ultimate seasonal barometer. So what's the whole point of all this work? It's to take a whole bunch of scattered, sometimes even conflicting data points and turn them into a single, clearer roadmap. It's all about weighing the evidence to figure out if the historical winds are at your back or blowing right in your face. And you know, this whole journey we've been on today, from that amazing story back in 1982, all the way to the logic of building one of these models, it's all drawn from the incredible and comprehensive work done by Jay Kaeppel in his book, Seasonal Stock Market Trends. It's just a testament to decades of really rigorous data analysis. Which leaves us with the million-dollar question, doesn't it? Seasonal analysis gives us this incredibly detailed map, a map based on more than a century of market history. It shows us where the smooth highways and the bumpy roads have been in the past. But will the future follow that same map? That's the question every single investor has to ask themselves.
All right, welcome. Today we're going to dive into a really fascinating and, sometimes pretty controversial idea, that the stock market has its own seasons. You know, the theory that just like winter turns to spring, the market follows these predictable, repeating cycles. But is there actually anything to it? Let's dig in and find out.
So let me ask you a question. What could falling autumn leaves possibly have in common with a rising stock chart? I know, it sounds a little strange, but stick with me, because the answer reveals this really powerful connection between the predictable rhythms of nature and the, well, seemingly chaotic world of finance.
So here's our game plan. First, we're going to talk about nature's rhythm and how it shapes our own moods. Then, we'll see how those collective moods can create the market's own emotional seasons. After that, we'll get a really clear definition of what seasonality actually is, meet the pioneers who first mapped all this out, and then we'll wrap up with a little preview of the specific patterns they uncovered.
Okay, let's jump into part 1, nature's rhythm, human moods. Before we can even begin to talk about stock charts, we have to start with something way more fundamental, us. It's all about how the world around us literally shapes the world inside our own heads.
Think about it. Our lives are just governed by cycles. The sun comes up, the sun goes down. Spring always follows winter. Now, these aren't just things happening in the background, they are the drumbeat that our entire lives march to. At our very core, we are creatures of habit, just conditioned by thousands of years of these predictable patterns.
in this has a profound effect on our psychology. I mean, you felt this, right? A thunderstorm can make you feel a little uneasy, that primal fear kicking in. A blizzard makes you want to just curl up and stay home. A dark, dreary day can put you in a total funk, where nothing feels quite right. But then, after days of that gloom, you open the curtains to a warm, sunny day, and boom, it's like magic. Your mood just lifts. That connection between our environment and our emotions, it's absolutely undeniable.
Okay, so we've established our moods are cyclical, but what in the world does that have to do with finance? Well, turns out everything. So in this next section, we're going to build that bridge and explore the market's emotional seasons. This is where human psychology smashes right into financial behavior.
This quote right here is so important. The stock market isn't just a bunch of numbers on a screen. You can think of it as a giant, real-time poll of our collective financial emotions. So if our own moods can change with the seasons, doesn't it make sense that the market, which is basically the ultimate arena for our financial hopes and fears, would have to reflect those same cycles? And this slide just illustrates the market's emotional seasons perfectly. Let's walk through it. A new bull market starts and optimism is blooming everywhere. That optimism can slowly grow into complacency, but then the market turns. And what comes next? Denial. The feeling that, no way, the good times can't be over. As losses start to pile up, that denial turns into real fear. And at the very bottom of the market, that's where you find total despair. But here's the thing. It's from that exact point of despair that the next season begins, and optimism starts to grow all over again. This cycle, it just repeats over and over and over. So now that we've laid that psychological groundwork, let's get to a really crucial distinction. What is seasonality really? Because understanding this difference is the absolute key to using this idea the right way.
The most important point is this: a seasonal trend is a repeating period with a tendency for the market to move in a certain direction. And I want you to focus on that word tendency. It does not say certainty. This isn't a guarantee. It's a statistical probability that we start to see when we look back over decades and decades of data.
And this right here is probably the single best analogy for this whole concept. Seasonality is climate, not weather. When you think about it, it makes perfect sense, right? You know the climate in Chicago in December is going to be cold. That's the probability. But the actual weather on any single day in December, it could be surprisingly warm. Seasonality tells you about the climate, the long-term odds. It can't predict the weather on any given day.
Now, this isn't just some folk theory somebody made up. It's actually a field of analysis with a pretty rich history. So in this next section, we're going to meet some of the pioneers who spent their careers doing some really groundbreaking research to map out these market seasons. These are the folks who took anecdotal observations and turned them into a real, data-driven field. It really got going with Yale Hirsch, who back in 1967 published the very first Stock Trader's Almanac, bringing these ideas to a much wider audience. Then, in '76, Norman Fosback built on it with some serious analysis, identifying patterns like that strength you see around the turn of the month. And by 1990, you had guys like Dick Stukin even mapping the investment climate to the 4-year election cycle. It was their work, together, that really built the foundation for everything we know today. So what did these pioneers and all the analysts who follow them actually find? All right, now we get to the exciting part. Let's get a preview of the specific, data-backed patterns that seasonal analysis has really brought to light.
So here are some of the big ones, the greatest hits of seasonality. You've almost definitely heard of the Santa Claus rally, right? That tendency for the market to be a bit stronger right at the end of December. Maybe it's holiday bonuses or just general optimism. Then there's the classic sell in May and go away, which points to a historically weaker 6-month period over the summer when trading often slows down. From turn-of-the-month strength, which could be linked to things like retirement fund inflows, to the 4-year election cycle. Each and every one of these is a specific data-backed hypothesis about how the market tends to behave. As we start to wrap this up, it's so important that we hammer home that central idea one more time. No one, and I mean no system, can pick market tops and bottoms with perfect accuracy. If anyone ever tells you they can, you should probably be pretty skeptical. That's not what this is about. That's trying to predict the weather.
Instead, the whole goal of understanding seasonality is just to identify periods when the historical odds, the climate, are in your favor. It's a tool for understanding probabilities. It might help you decide when it could be smart to be a little more aggressive or maybe a little more defensive, all based on decades of historical data. Think of it as just one more piece of the puzzle to add to your overall investment strategy. And that leaves us with one final, pretty important question. I mean, you wouldn't pack a heavy winter coat for a summer vacation, right? So if the market really does have its own distinct seasons,
Does it make sense to use the exact same investment strategy all year round? Now that's a powerful idea to think about. Thanks so much for joining me for this explainer.
So, today we're going to dive into a really strange and, surprisingly persistent piece of Wall Street folklore. It's called the January Barometer. And it makes this simple, almost unbelievable claim that the stock market's performance in just the first month can somehow predict the entire year to come.
But come on, can it really be that simple? Can 1 month, just 31 days, really tell you what's going to happen for the next 11? I mean, it sounds a lot like financial astrology, right? But here's the crazy part. When you actually look at the historical data, the results are, well, they're surprisingly compelling. So let's dive in and see what the numbers actually say.
Okay, so the core idea, which was first really detailed by an analyst named Yale Hirsch way back in 1972, is captured in this simple phrase. As goes January, so goes the year. Pretty straightforward. If the market is up in January, that's seen as a super bullish sign. If it's down, well, you might want to buckle up. We're going to be looking at 70 years of data here, all the way from 1937 to 2007, to see if this old saying actually holds any water.
But it turns out the theory gets even more specific, even more granular. One variation says you don't even need to wait for the whole month to get a signal.
Yeah, this little piece of the puzzle is known as the first 5 days indicator. And the idea is exactly what it sounds like, that the market's direction in just the first week of trading can somehow foreshadow what's going to happen for the rest of the year. I know, it sounds completely random, but let's just hold that thought and look at the data. So check this out. This chart shows you exactly what that strategy looks like in practice. It tracks the growth of $1,000 but with a very specific rule. You only invest your money from February to December and only in the years when those first 5 days of January were positive. The trend? Well, you can see for yourself. It's unmistakably upward.
And if you want to put a hard number on it, here it is. After a positive signal from just those first 5 days, the rest of the year, that February through December period, also finished with a gain 82.2% of the time. Now, for a rule that's based on just 1 week of trading, that is a surprisingly high success rate.
Okay, so the start of the month is interesting, but it's not the only period that seems to matter. The source material we're digging into here points to another, maybe even more powerful 5-day window.
This is pretty wild. The author of our source material actually stumbled upon something fascinating in their research. The performance of the last 5 trading days of January has historically been an even better predictor than the first 5. Who would have thought?
And, yep, the chart backs this up completely. Again, we're looking at the growth of $1,000 invested from February to December, but this time, the trigger is a positive performance in the last 5 days of January. And look at that. The upward climb here is even steeper. The accuracy rate for this last 5 days signal actually ticks up to 83.3%. Now, that might seem like a small improvement over the first 5 days, but you have to remember, in the world of market analysis, traders are always looking for that tiny extra edge.
All right, so we've looked at these little 5-day windows at the beginning and the end of the month. Now let's zoom back out and look at the original theory itself, the performance of the entire month of January. And this is the classic January Barometer in action. The chart shows the growth of our $1,000 investment, but only in years where January as a whole finished in the green. The performance here is, frankly, just staggering compared to those shorter-term signals. It's on another level.
And here it is. This is the headline number, the big one, that has kept this theory alive for so long. When the full month of January was positive, the following 11 months were also positive, an absolutely incredible 91.4% of the time. That's more than just a correlation. It's a historically powerful signal that's practically screaming at you from the data.
So what do we have? We've got 3 really interesting clues. The first 5 days, the last 5 days, and the full month. So what happens if we stop looking at them as separate signals, and instead, what if we combine them into a single comprehensive model?
Well, the author of the source material did just that. They created what they call the January Barometer, and it's a really simple scoring system. You get 1 point if the first 5 days are up, you get another point if the last 5 days are up, and you get a third point if the full month is up. This gives us a final score for January that can range from 0, the absolute most bearish signal you can get, all the way up to 3, the most bullish.
And this is where the power of combining these signals becomes crystal clear. Just look at the contrast, it is dramatic. On the left, you see the years that scored a big fat 0. All 3 indicators were negative. In those years, an investment of $1,000 would have been cut almost in half. Ouch. But on the right, for the years that scored a perfect 3, that same $1,000 would have exploded to over $17,000. The outcomes just couldn't be more different.
Now, this scoring system is really powerful, but at the end of the day, it's still just an observation. So the source material takes it one huge step further by building these signals into a complete rules-based trading system.
So let's just walk through the rules of this ultimate system. If you get a perfect score of 3, the system goes full-on aggressive. It uses 2 times leverage, which means for every dollar you have, you borrow another to double down on your investment and your potential returns. For a score of 2, it's more straightforward. Just invest in the Dow, no leverage. If the score is just 1, it plays it super safe and just holds cash. And for that dreaded 0 score, the system does the complete opposite of buying. It actually shorts the market, which is basically betting that prices are going to fall. So there you have it. Those are the rules. It's an objective system based entirely on what happens in January. Now, for the moment of truth, how did this system actually perform over 70 years? And maybe more importantly, what are the hidden risks?
Take a look at this chart. The gray line you see there, that represents a simple buy and hold strategy for the Dow Jones. The black line, well, that's the performance of the ultimate system. And the difference is just breathtaking. The system doesn't just outperform, it's playing in a completely different league. Let's put some final, mind-boggling numbers on this. That initial $1,000 investment, just by following the system's rules from 1937 to 2007, would have grown to over $5.3 million. For comparison, a simple buy and hold strategy over that exact same period would have turned that $1,000 into about $110,000. The outperformance is it's staggering.
And this is a huge, massive but. That performance came with some absolutely gut-wrenching volatility. Remember that 2 times leverage we talked about? Well, in 1987, a year where the system was fully leveraged, it got caught in the infamous Black Monday market crash. And in that single event, the system suffered a drawdown over 63%. Can you imagine watching your portfolio get cut by nearly 2/3?
So what's the big takeaway here? Well, historical data is pretty clear. January indicators have shown some remarkable predictive power, and when you combine them, they seem to get even more potent. The system produced returns that are honestly hard to ignore. But, and this is for sure the most important part, that incredible reward came with a level of risk and volatility that most people, myself included, simply couldn't stomach. It is absolutely crucial to remember this is a look back at what has happened, not a guarantee of what will happen. This is an interesting thought experiment, not financial advice.
Which really leaves us with one final question. Are we looking at a 70-year winning formula that just seems to defy all logic? Or is this whole thing really just a powerful and maybe a little bit painful lesson in the relationship between extraordinary returns and absolutely terrifying risk? Something to think about.
You know that feeling around the holidays? That general sense of optimism and, well, cheer? We all feel it. But what if I told you that collective good mood might actually show up in the stock market? Today, we're going to dive deep into the data and ask the question, does holiday cheer really move the markets? All right, so here's how we're going to break this all down. First, we'll look at the big picture, the holiday effect itself. Then we're going to zoom in on the single most powerful day. After that, we'll expand our view to a wider window, see what that tells us, and even build a practical trading system based on what we find. Then, of course, we have to put the famous Santa Claus rally under the microscope, and we'll wrap it all up by asking the big question, can this magic really last? All right, first things first, the holiday effect. For decades, traders and analysts have noticed something kind of strange. The stock market just seems to do better around major holidays. It's this really fascinating intersection where human psychology and our collective good mood seem to spill right over into our financial decisions. And that really gets to the heart of it, right? Is this just a feeling, a nice story we tell ourselves, or can we actually see it in the data? Is there a real, quantifiable phenomenon at play here? Well, let's find out.
Now, we're not just guessing here. We are digging into a massive data set. We're looking at these 8 major U.S. holidays, using Dow Jones data that stretches all the way from 1933 to 2007. That's over 70 years of market history. So what does it all tell us?
Okay, so we know there's something going on around holidays, but let's get specific.
Let's zoom in on what the data shows is the single most powerful day of all, the day right before a holiday. This is where things get really, really interesting.
Okay, just look at this chart. It's pretty incredible. This shows what would happen if you invested $1,000 only on the day before a major holiday. For 57 straight years, from 1933 to 1991, it was almost a straight line pointing up. And even after it flattened out for a bit, it still hit a brand new high in 2007. The consistency here is just wow.
So let's put a number on that. Just how much better are we talking about? Well, the average daily return on these pre-holiday days was a staggering 8.4 times greater than all other trading days combined. That's not just a small edge. That's a massive, undeniable performance gap.
And get this, if you could somehow bottle up the returns from just these few days each year and annualize them, you'd be looking at a mind-blowing 62.3% gain. Now compare that to the annualized return for every other day, just 5.9%. It's not even in the same ballpark.
Now you might be thinking, okay, but was that just a few huge days that threw off the average? Nope, it was remarkably consistent. Over 62% of these pre-holiday days finished with a gain. For all other days, it's basically a coin flip at just under 52%. This shows a real, persistent upward bias.
Okay, so the day before holiday is clearly a big deal. But what happens if we zoom out a bit? Does the magic extend to the days surrounding it? Let's widen our view and see what happens.
So on the screen here, we've got two different views. On the left, we're looking at the 2 days before the holiday. On the right, we've got a full 6-day window. That's 3 days before and 3 days after. And what's really fascinating is that the wider 6-day window has actually continued to hit new highs much more recently. It seems like the effect might be spreading out a little.
This table lays it all out perfectly. It really shows the trade-off, right? As you widen that window from 1 day to 2 days to the full 6 days, look what happens to the total growth of your $1,000. It skyrockets. But at the same time, the efficiency drops. The annualized return and the outperformance multiple both go down. So you make more money in total, but you have to be in the market longer to capture it.
So what's the big takeaway here? Well, it looks like the holiday effect isn't disappearing, it's just changing its shape. It's become less of a single-day firework and more of a slow burn, spreading out over that wider 6-day window.
Okay, so we've looked at all this data. That's great. But what can we do with it? Can we turn this insight into an actual practical strategy? Let's take a look at something called the ultimate holiday system.
But hold on. Before we get into that, there's a really important word of caution from the source material we need to talk about. It's this idea of cherry picking. It's so tempting to look at the data and say, I'll just trade that one best day. But that's really dangerous because there's often no solid logical reason why one specific day should keep outperforming forever.
So with that in mind, let's look at the rules for this ultimate holiday trading system, or UHTS for short. It takes that wider 6-day approach. You go long the Dow 3 days before and 3 days after the holiday. But here's the kicker. For that 1 day right before the holiday, the one we know has the strongest historical edge, the system applies 2-to-1 leverage to really amplify potential gains. And on every other day of the year, you're just sitting safely in cash.
And the results? Well, they speak for themselves. Look at that growth curve. This system turned $1,000 into a huge pile of cash. And the most amazing part? It did all of that while only being invested in the market about 18% of the time. The other 82% of the year, it was just sitting on the sidelines, completely avoiding the market's day-to-day drama. Okay, the big question. How does this stack up against a simple buy and hold strategy? Well, to be fair, buy and hold did make more money in absolute terms. But look closer. The UHTS captured about 76% of the profits while being exposed to market risk for less than 1/5 of the time. From a risk-adjusted perspective, that is an absolutely incredible result.
Okay, we've talked about a great all-around system. But let's be honest, there's one holiday trend that everyone's heard of, the Santa Claus rally. Is it still the gift that keeps on giving, or has Santa's bag of goodies gotten a little lighter?
So, just so we're all on the same page, what exactly is the Santa Claus rally? It's that specific short period of time, the last handful of trading days of the year, right between Christmas and New Year's. Historically, it's been famous for being a surprisingly strong time for the market.
But here's where it gets really fascinating. The data shows a pretty clear twist. For the big, large-cap stocks in the Dow, the rally has kind of fizzled out. The average gain has shrunk to almost nothing. But if you look at the small-cap stocks in the Russell 2000, the rally is stronger than ever, with really robust gains. So the magic isn't gone. It seems like it's just moved to a different part of town where fewer people are watching.
All right, we've gone through a ton of data. We've built a system. We've even looked at Santa himself. But it all comes down to one final crucial question. In today's super-fast, hyper-efficient markets, can this kind of magic really last?
You know, the source text itself asks this very question, and I think it puts it perfectly. Is it possible that because so many people are now aware of these historical trends that they are now becoming muted? Yes, it is possible. It's the classic market paradox. The more people who know a secret, the less of a secret it becomes.
So that's really the final thought I want to leave you with. We've seen clear evidence that the holiday effect is changing. It's spreading out over more days. It's shifting from large stocks to smaller ones. Is this just the effect adapting and evolving, or is it the beginning of the end? Will this anomaly fade away as more people learn about it, or will it just keep finding new ways to surprise us? Only time will tell.
You know, for years, we've all been told that the stock market is this chaotic, totally unpredictable beast, that its day-to-day movements are just, well, random noise. But what if that's not the whole story? What if there's a hidden rhythm, a predictable pulse that's driven by something as simple and as regular as when we all get paid? Let's dive in and see.
So this is really the big question, isn't it? Is the market just one big roll of the dice, a financial casino where anything can happen at any moment? Or are there underlying patterns, actual mechanical forces at play that could give us a much deeper understanding of how it all works?
Now, the conventional wisdom, the thing you learn in finance class, it has a name, the random walk theory. And it basically says that a stock's price tomorrow has nothing to do with its price today. It's a clean slate every single morning. Trying to predict it is like guessing a coin flip. The odds are always 50-50. But the material we're looking at today suggests there might be a pretty big flaw in that idea.
And the whole counter-argument really boils down to this incredibly simple but really powerful idea. It's not about feelings or complex algorithms or magic. It's just mechanics. It's the physical flow of actual cash into and out of the market that creates these powerful currents, these waves of buying and selling that we can actually see and track.
I mean, this is straight out of Economics 101, right? It's the bedrock of any market. When a flood of new money comes pouring in and all that cash is looking to buy stocks, you've just created a massive surge in demand. And since there's only a limited supply of shares for sale at any given time, what happens? Prices get pushed up. And of course, the opposite is true too. It all just comes down to that simple balance of buyers and sellers.
So, okay, let's follow the money step by step. It all starts with paychecks, millions of them landing in bank accounts. Then, a chunk of that money is automatically siphoned off into retirement accounts, your 401ks, your IRAs. But that cash doesn't just sit there. It floods into these giant mutual funds. And the fund managers, well, they're legally required to put that money to work. How? By buying stocks. And this creates a predictable, recurring wave of demand. See, it's not random at all. It's a financial cycle that's literally tied to our work cycle.
Okay, so what's really fascinating here is how this predictable flow of cash seems to break the month down into 5 distinct waves of market performance. And we're not talking about some recent trend. Let's look at the data, because it goes back over 100 years. So wave 1 is what we're calling the strong start. And just look at this chart. It is incredible. What you're seeing is the hypothetical growth of an investment that was held only during the first 5 trading days of each month. This is that first big tidal wave of new month money hitting the market, and you can see the effect is, well, it's powerful and remarkably consistent over the long haul.
But then, almost as soon as it comes in, the tide goes right back out. Wave 2, which covers just trading days 6 through 8, is a complete reversal. That initial buying pressure is just gone, and the market is suddenly left without that powerful tailwind. As you can see from this chart, this short period has historically been a consistent loser. I mean, the difference between this and the first wave is like night and day.
All right then, right around the middle of the month, we get wave 3, the mid-month bulge. And this is so interesting. Before the 1980s, this period was basically flat, nothing to write home about. But right around the time that IRAs, those individual retirement accounts, became really popular, it started showing consistently strong gains. And the likely reason? Well, a lot of people also get paid mid-month, which creates a second, smaller wave of those automatic investments.
But after that little mid-month party, we enter the longest dry spell of the entire month.
Wave 4 is like a death valley for stocks. It spans roughly from the 13th to the 20th trading day, and also a few days near the end of the month. This is when that institutional buying pressure, that flood of cash we talked about, is at its absolute lowest. And over the long run, it has been a consistently awful time to be in the market.
And that brings us to our final phase. Just when things look their bleakest, we get Wave 5, a strong finish in the last 2 trading days of the month. Now, one theory for this is something called window dressing. This is where big fund managers might buy up stocks that have done well that month just to make their portfolios look better for their end-of-month reports. Whatever the reason, the data is crystal clear. There is a bullish tendency right at the finish line.
Okay, so we've laid out these different waves of good times and bad times. But what's the actual real-world impact of all this? Like, what happens if we run a couple of thought experiments based on these patterns? This, right here, is where the story goes from interesting to absolutely dramatic.
So let's start with a hypothetical. Imagine an investor starting way back in 1900, and they decide to only put their money in the market during those lull periods we identified, the historically worst performing days of every single month. What do you think would happen to their money over the next 100+ years?
Well, the result is an absolute catastrophe. Just look at this chart. It's a steady, relentless march to the bottom. During a century where the Dow Jones gained over 18,000%, this bad days only strategy would have turned $1,000 into just $92, a near total wipeout.
Yeah, just let that sink in for a second. A staggering loss of over 90%. And that was achieved just by being invested on the same repeating set of unfavorable days, month after month, year after year. So the point is, these aren't just little dips. The data suggests these are historically toxic periods for your money.
Now for the mind-bending flip side. What if another investor did the complete opposite? They didn't try to be a genius and pick the best days. They simply avoided the handful of historically worse days we just looked at, and they just stayed invested on all the other days. What happens then?
The result is breathtaking. That same $1,000, by simply sidestepping those weak periods, would have grown to over $2 million. The difference between this chart and the last one tells an unbelievable story. It strongly suggests that the vast majority of the stock market's entire long-term gains have been concentrated in very specific, recurring parts of the month.
And look, this isn't just some statistical fluke from one particular era. This slide here breaks it down decade by decade. Just look at these numbers. In every single decade, for over a century, the basket of non-worst days has crushed the basket of worst days. It didn't matter if it was the roaring 20s, the stagnant 70s, or the dot-com boom of the 90s, the pattern held. That kind of consistency is what really makes you think you're seeing a structural feature of the market, not just some random coincidence.
So, after looking at all this data, let's circle all the way back to where we started. What does all this tell us about that big idea that the market is just a random walk?
Well, let's just hammer home the most stunning takeaways here. Okay, think about this. Over the last 70+ years, all of the market's net gains, every single penny of profit, was made on just 6 specific trading days per month. If you were only invested on all the other days, you would have actually lost money over that entire time. The average daily gain on those good days was 72 times greater. 72! That's just astonishing.
This quote from the source material really just sums it up perfectly, doesn't it? While the random walk theory insists that every day is a fresh start, that the odds are always the same, the historical data seems to be screaming the exact opposite. It suggests that, thanks to the predictable mechanics of how money flows into the system, some days are just born with a huge measurable advantage.
And that kind of leaves us with one last big thought. If patterns this clear, this powerful, and this persistent over more than a century can be found and measured, it really forces you to question that core assumption of total randomness, doesn't it? It suggests that maybe, just maybe, beneath all the daily noise, there's a predictable rhythm. And what you do with that information, well, that's up to you.
What if I told you the stock market's chaos isn't quite as random as it seems? That beneath all the daily noise, there might be a hidden rhythm, a century-old secret that repeats, decade after decade. Today, we're pulling back the curtain on the stock market's 10-year secret.
All right, let's just jump right in. We're constantly bombarded with headlines, economic data, and expert opinions. It's a ton of noise. But what if there's a simpler pattern hiding in plain sight? A rhythm that doesn't play out day by day, but decade by decade. That is the exact question we're going to dig into.
You know, if you follow the markets, you've probably felt this. There's so much information coming at you that you just freeze up. It's a real thing. It's called analysis paralysis. You get so lost in the weeds, you can't see the forest for the trees, and you end up doing nothing. So for a minute, let's just ignore all that noise. Let's step way back and see if we can find a clearer, decade-long signal.
Okay, so how are we going to find that signal? Well, we're going to start by breaking down more than 100 years of market history into decades. And then we're going to rank each year of the decade, year 0, year 1, year 2, and so on, to see if any kind of pattern starts to show itself. And here it is. This is the data from 1900 all the way to 2007. And wow, right away, something just jumps off the page. The decade seems to get off to a really rocky start, right? Look at the bottom. Years 0 and 1 are the only ones with a negative average return. But then you look at the top of the list, and 1 year is in a completely different league.
I mean, just look at that number, a positive 31.4% average gain. This is what we're calling the Year 5 phenomenon. It's not just the best year of the decade. It's a massive, massive outlier. The next best year doesn't even come close. It's down there at around 20%.
And on the flip side, you have the decade's clear loser, Year 0. Historically, the first year of a brand new decade, think 1990, 2000, you get the idea, has been the absolute worst time to be in the market. We're talking an average loss of almost 7%. So when you put the top 3 performers right next to the bottom 3, the difference is, well, it's just night and day, isn't it? The best years have delivered some seriously powerful gains, while the worst years, on average, just flat out lost money. This brings up a pretty fascinating thought, doesn't it? What if you could have just skipped the bad years?
So let's do that. Let's put that idea to the test. We're going to run a really simple but I think a really powerful thought experiment. We'll compare 3 different ways of investing over that same 108-year period to see how much of a difference this pattern could have actually made.
Okay, here's the game plan. Strategy A is our baseline. It's super simple. You just buy the Dow Jones Industrial Average and hold on for dear life. Strategy B is our pattern follower. You only invest your money during the 7 historically good years. And then there's strategy C, which does the exact opposite. You only invest during those 3 historically weakest years.
And the results are, well, they're pretty mind-blowing. If you'd put $1,000 in and just held on, you'd have a very respectable $199,000. Not bad. But strategy B, the one that just sat on the sidelines during the 3 worst years each decade, would have turned that same $1,000 into over $1.7 million. That's almost 9 times more money. And poor strategy C. If you only invested in the bad years, your $1,000 would have been almost completely wiped out, leaving you with just $113.
And these charts just illustrate it perfectly. On the left, you see that explosive hockey stick growth from only being in the market during the strong years. And then on the right, well, you see the slow, painful death of your money from being invested only in the weak ones. The visual really says it all. Okay, so case closed, right? Just avoid year 0, 1, and 7, and you're all set for life? Well, with the market, it's never quite that simple. We've got to peel back another layer here to really understand what's going on. So what happens if we take that whole 108-year history and we just chop it in half? Let's compare how the pattern worked in the early part of the century versus how it's worked in the more modern era. Now, in that first period, from 1900 up to 1941, the pattern was brutally effective. Investing only in those bad years would have been an absolute catastrophe. You would have lost 94% of your money, turning $1,000 into just $59. This era had some of the worst bear markets in history, and they just happened to fall right in those years.
But, and this is a huge but, look what happens from 1942 onward. The whole thing flips on its head. Strategy C, investing in those so-called bad years, actually made you money. It almost doubled your investment. And because of that, strategy B, our supposedly smart strategy, ended up making way less than a simple buy and hold approach. Following the old pattern blindly would have cost you a ton of money.
And this leads us to what is probably the most important takeaway of this whole thing. This 10-year pattern, it isn't some magic formula. It is not a rigid, do this, don't do that trading rule. The real key is to think of it more like a frame of reference, a mental model that helps us understand the market's long-term habits and historical rhythms.
So with that idea in mind, let's zoom out. Let's stop looking at individual years and start looking at the entire decade as a kind of journey. When we put all this data together, we can actually create a single, averaged, decennial roadmap
that shows the typical ebb and flow of the market.
And this is it. This chart is basically the average story of a decade, told month by month, based on over a century of data. And when you look at it this way, you can see a really clear, repeating narrative, almost like a four-act play that history has put on again and again.
So let's break down that play. Act 1 is the early lull, a pretty sleepy, weak start to the decade. Act 2 is the mid-decade rally, this really powerful surge right in the middle. Act 3 brings the 7/8 sell-off, which is often a sharp, kind of scary drop. And then finally, Act 4 is the late rally, a strong finish that carries us into the next decade. It's a great story, for sure. But the real question is, how reliable is it? I mean, does the market actually follow this script decade after decade? Let's look at the numbers and see how often these big trends have really happened. Well, this table gives us the answer. The early lull shows up about 73% of the time, which is pretty often. And the trends near the end of the decade are even more consistent, happening about 4 out of every 5 decades. So those are pretty strong tendencies. But one of these trends, it isn't just a tendency. It's been an absolute certainty.
That's right, the mid-decade rally is the undisputed king of these trends. It has a 100% reliability rate. According to this data, every single decade for over a century has had a powerful stock market rally sometime around its middle years. It is the most consistent pattern there is.
So when it's all said and done, while the entire 10-year pattern is a fascinating way to frame things, that mid-decade rally has proven to be its most powerful and reliable part. And that leaves us with one final big question to think about. Looking at this historical roadmap, what part of the journey do you think we are on right now?
All right, let's get right into it. Today, we're cutting through all the usual market chatter to tackle a really fascinating question. Are there actual, predictable rhythms hiding in the stock market? You know, if you watch enough financial TV, you hear analysts talk about cycles all the time, right? But their predictions, they always feel so vague, so unreliable. It's almost impossible to do anything with them. And see, here's the problem. It's the huge difference between subjective guesswork and what we're talking about today, truly objective, measurable cycles. When an analyst says a cycle is due sometime in the next week, that's not a strategy, that's just a guess. We're on the hunt for cycles with exact start dates that repeat with precision, because those are the only ones you can actually test. So in this explainer, we're going to bust that myth wide open. We're diving into 3 specific, objective cycles, from a massive 4-year supercycle all the way down to a tiny 53-day pattern. These have shown some remarkable predictive power over decades of data. And then we'll ask the big question, what happens when they all line up? Okay, let's dive in, and let's establish our one core principle right now. We are only looking at cycles that can be objectively tested over long periods of time. No feelings, no interpretations, just the data. So, we'll be digging into 3 totally distinct cycles, a 212-week one, a 40-week one, and a 53-day one. And what's so cool about this is that their durations are all different. That means they aren't just echoes of each other. They each give us a unique piece of the puzzle. Let's start with the longest, and maybe the most powerful pattern of them all, the 212-week cycle. This is the big one, often called the 4-year cycle. Okay, so this cycle lasts exactly 1,484 days. And the rule we're testing is so simple, it's almost beautiful. Buy the Dow Jones Industrial Average on the very first day a new cycle begins. And just hold it for exactly 6 months. That's it. Super simple, totally objective, and really easy to test. And just look at the data going all the way back to 1938. The performance in these 6-month windows has been incredibly positive and significant. We're talking an average gain of 14.5%. But now look at the column on the far right, the worst declines, the drawdowns. They were tiny. Now this is where it gets really visual. This chart shows the growth of $1,000, but only if you invested during those 6-month windows. The long flat lines, that's the 3.5 years you're just sitting on the sidelines, out of the market. It is just stunningly consistent growth from a strategy that's only active about 12% of the time. So here's the crucial point. Let this sink in. The average daily gain during this special 6-month period was 5.5 times greater than the average gain during all the other trading days combined. That is an enormous difference. And the numbers that back this up are just so compelling. You've got an 89% win rate, that 14.5% average gain, and this is really key, very little downside. In 15 out of the 18 cycles, you never would have been down more than 5%. That points to something really rare, a period of high returns and low risk at the same time. And this chart just says it all, doesn't it? The black line is your money growing when you're invested only in those 6-month windows. The gray line, well, that's your money if you invested the other 88% of the time. You literally would have made more money being in the market for just a fraction of the time. It's incredible. Okay, let's move to our next cycle and see how this all builds. This one is a more frequent pattern, which means we get more chances to see it in action. We're talking about the 40-week cycle. So for this one, we're taking that 40-week period and just chopping it right down the middle. We've got a 20-week bullish phase, and that's followed by a 20-week bearish phase. The big question is, does the market act differently in the first half compared to the second? And the answer is a huge, resounding yes. Just look at this. During the first 20 weeks of each cycle, that so-called bullish phase, the market shows this powerful and consistent upward trend. $1,000 would have grown to over $21,000. But then, in the second 20 weeks, the bearish phase, the performance is drastically different. It's like a different world. An investor who only stuck to this period would have seen their $1,000 actually shrink to just over $700 over 40 years. I mean, the difference in the annualized returns is just, it's stark. It's night and day. You've got a positive 17.7% return in the bullish phase versus a slightly negative return in the bearish phase. It's like two completely different markets are operating on this predictable schedule. And this right here is a massive takeaway. That bearish phase isn't just a time of lower returns, it's also a period of way higher risk. The worst market crashes, the big, nasty bear markets, they have overwhelmingly happened during the second half of this cycle. Now for our final and shortest cycle. This one adds a really important layer of nuance to our whole analysis. This is the 53-day cycle, which repeats roughly every month and a half. We're gonna apply the same logic here as we did with the 40-week cycle. We'll split this microcycle in half. The first 27 days are our bullish phase, and the final 26 are the bearish phase. But the results might surprise you a little bit on this one. Okay, check this out. Unlike the other cycles, the so-called bullish phase, which is the black line here, was actually a laggard for a very, very long time. For the first 2 whole decades of the test, the bearish phase actually did better before the trend finally flipped. And this is exactly why the source author puts out a very clear warning. It actually builds a lot of credibility because he's acknowledging a crucial fact. This cycle is not some kind of magic bullet on its own. Its inconsistency in the past means you'd never want to trade based on it alone. So where does that leave us? We've seen 3 distinct objective rhythms in the market. We have the powerful 212-week supercycle, the really consistent 40-week pattern, and then this more nuanced 53-day microcycle. And this all leads us to one final, really provocative thought. If these cycles have this kind of predictive power all by themselves, what on earth could it mean for the market when their bullish energies align? What happens when the 212-week, the 40-week, and the 53-day cycles all turn bullish at the exact same time? Now that is a question worth thinking about.
Welcome to The Explainer. Today, we're going to dive into a really fascinating idea that connects the White House to your wallet. It's called election cycle investing. We're going to explore whether the very predictable rhythm of politics creates a surprisingly predictable rhythm in the market.
All right, here's how we're going to break it all down. First up, we'll look at the core theory. Then, we'll get into the nitty-gritty of the cycle, year by year, and see how the first half of a presidential term stacks up against the second. After that, we'll zero in on what the data says is the absolute best time to invest. And finally, we'll talk about what all this history might mean for you.
So, let's just jump right in with the big question that's probably on your mind.
So does the US president really pull the strings on the stock market? Well, it's not quite that simple. But there is a really compelling theory that says the predictable 4-year election cycle creates patterns that investors can actually observe. The whole idea isn't about trying to predict the economy, because let's be honest, that's nearly impossible. It's about leveraging predictable patterns in political behavior.
Okay, so here's the heart of the theory. The thinking goes like this. Politicians want to get reelected, right? So they push through any tough or unpopular policies, all the dirty work, early on in their term. That gives the economy and all of us voters plenty of time to recover and hopefully forget the pain.
Then, as the next election gets closer, the focus completely shifts to making everyone feel prosperous to win those precious votes.
Now, let's zoom in and meet the 4 distinct personalities of the election cycle. Because, historically, each year of a president's term has behaved very, very differently.
The first year right after an election, this is when a new or re-elected administration often gets that tough stuff done that we just talked about. And because of that, it has historically been the weakest, most inconsistent year for stocks. I mean, if you look at the Dow since the 1930s, it's been down more often than it's been up, with a pretty underwhelming average performance.
So then we get to year 2, the midterm year. This one is often seen as the rebound. The theory is that after all the nastiness of that first year plays out, the market kind of hits a bottom and starts looking ahead to better times. Performance gets better, with the Dow gaining about 6.7% on average, but it can still be pretty choppy.
But now, oh boy, now we get to the absolute star of the show. If you had to pick just one single year of the cycle to be in the market, history makes a very strong case for this one.
The historical performance of pre-election years has been, well, just look at it, remarkably consistent. This chart shows what would happen if you invested only during those years, and the strength of this upward trend is just incredible. It's all driven by that simple fact. This is the year when administrations are typically doing everything in their power to make the economy look great for the election coming up.
And the data, the data is just staggering. Get this, the Dow has posted a gain in 18 out of the last 19 pre-election years. You have to go all the way back to 1939, right as World War II is starting, to find the last time it didn't. With an average gain of a whopping 15.1%, this year has been the cycle's most reliable and powerful performer, and it's not even close.
And that brings us to the election year itself. It's generally been positive, with a respectable average gain. But it is way less consistent than the pre-election year. And the reason for that boils down to one thing the market truly hates: uncertainty. When an election is tight and nobody knows who's going to win, the market tends to get really nervous.
So, we've seen each year has its own vibe, but what happens when we group them together? This is where the election cycle theory really comes into focus.
The contrast is just stark when you compare the first 2 years of the cycle against the last 2. The first half is often volatile, unpredictable, a bit of a roller coaster. The second half, on the other hand, has historically been much stronger and way more consistent. But just how big is that difference we're talking about? Okay, let's put some numbers on it. Imagine you invested $1,000 in the Dow, but only during the first 2 years of every presidential cycle, from 1934 all the way to 2007. Your money would have grown to just under $2,500. It's a gain, sure, but not exactly spectacular over 70+ years. Now, hold on. What if you took that same $1,000 and invested it only during the last 2 years of each cycle over that same time frame? Your investment would have grown to over $52,000. That's the difference between a 145% gain and a 5,111% gain. It's night and day.
And this chart just illustrates the difference brilliantly. That line kind of crawling along the bottom, that's the growth during the volatile first half. And that rocket ship at the top, that's the explosive and consistent growth during the second half. That performance gap is just so compelling, and it really highlights the core of this entire theory.
So the crucial point is that the second half of the cycle has been historically powerful, but the data lets us get even more specific. Can we actually find an even more reliable period inside that second half? Well, researchers who dug into this have identified what they call a 15-month sweet spot. This period kicks off on October 1st of the midterm year and runs all the way through the end of the pre-election year. And looking at 19 cycles of this period, it showed a gain 18 times, with an incredible average gain of over 25%.
This 15-month window is incredibly strong. But if you look really closely, even within this powerhouse period, there's one month that consistently underperforms and just adds a lot of unnecessary volatility.
And that problem child is October of the pre-election year. As you can see from this chart, it has been down more often than up, and it was famously home to the massive stock market crash of 1987. But even if you take out that one huge event, its performance has been pretty weak compared to the other 14 months in the sweet spot.
So what happens if we just avoid that 1 month? By simply sidestepping October of the pre-election year, we create a refined 14-month favorable period.
And get this refined period has shown a gain in all 19 cycles since 1934. It smooths out the ride and, historically at least, has led to even better risk-adjusted returns.
So let's zoom back out and think about what all this historical data means for an investor who's thinking about the future. What's the big takeaway here?
Okay, this is absolutely critical to remember. It's the most important rule of investing, right? Past performance is no guarantee of future results. These are historical tendencies, they are patterns, they are not certainties. The world can change and any number of things could disrupt this long-standing pattern.
Look, this isn't about having a crystal ball, but the election cycle theory offers a powerful lens for understanding the market's historical tendencies. It reveals a pattern that's driven by the predictable rhythms of human behavior and political motivation. It's not about making guarantees, but it's about giving you a new rhythm to listen for in your own investment strategy.
You've probably heard that old saying on Wall Street, right? Sell in May and go away. It sounds almost too simple, a little too easy to actually work. Well, today we're going to put that classic adage to the test. We're diving deep into nearly 60 years of data to see if there's any real fire behind all that smoke. But let's just start with a crazy thought. What if you could make more money by only being invested in the stock market for 6 months out of the year? Seriously. Imagine working half the time, taking the other half off, and actually coming out ahead. That's the powerful, almost unbelievable idea we're going to unpack right now. Okay, so here's our roadmap. First, we'll cover the basic idea of this 6-month investing year. Then, we'll look at the hard evidence behind the simple strategy. After that, we're going to see if we can juice the results by adding a cool technical indicator called MACD. Then, of course, we'll see how that new filtered strategy performs, and we'll wrap it all up with the biggest takeaways. So let's jump right in, the 6-month investing year. And, this isn't some newfangled idea that just popped up online. Nope, this is a seasonal strategy that's been around for a long, long time, and it was first popularized by a true legend in the world of market analysis. And that legend is Yale Hirsch. If you follow the markets, you know his work from the Stock Trader's Almanac. He was one of the first people to really notice and document this strange but incredibly persistent pattern in the market. The fact that pretty much all of the stock market's gains seem to happen in one specific 6-month window. So what are the actual rules here? You're going to love how simple this is. Step 1, you buy the Dow Jones right at the end of October. Step 2, you sell everything in early May and just move to cash. And step 3, you do nothing. You just sit in cash, relax, go on vacation, whatever, until the end of next October, and then you do it all over again. That's it. All right, I know what you're thinking. That sounds way too easy, right? There's got to be a catch. So let's get to the most important question. Does this thing actually work? Well, it's time to stop talking and start looking at the numbers. Let's see what the data says. Okay, check this out. This chart shows what would have happened to $1,000 if you only invested it during those good months, from November to May, every year from 1949 all the way to 2007. I mean, just look at that curve. It's just a steady, relentless climb upwards for almost 60 years. It's exactly what you want your investment portfolio to look like. And the final number? Get this, your initial $1,000 would have turned into more than $82,000. That's an incredible return, especially since you were only invested half the time. But, and this is a huge but, what happened if you invested in the other 6 months? You might want to brace yourself for this one. And here it is. This is the other side of the story. This is your $1,000 invested only during the so-called bad months, from May to October. Yikes. Instead of that beautiful upward climb, you get this choppy, chaotic mess that basically goes sideways and ends up going absolutely nowhere. I mean, the difference is just night and day. And here's the real kicker. After almost 60 years of being invested during that May to October period, your $1,000 didn't just go nowhere, it actually lost money. It shrank to just $847. You would have literally been better off just hiding the cash under your mattress. Unreal. Let's put these numbers side by side because this is where it gets really stark. The November to May period, a fantastic 17.1% average annual return. The May to October period, a pathetic 0.6%. The data is screaming at us here. Basically, all of the stock market's gains over this massive 58-year time frame came in just 6 months of the year. Okay, so we've established that the basic sell in May strategy is shockingly effective. But you know us, we're always asking, can we do better? What if we could level this up? In this next part, we're going to see if we can make this already good strategy even better by adding a little technical filter to help us time our entries and exits. This is where it gets really fun. The tool we're going to bring in is called the MACD. Now, don't worry about the long name, moving average convergence/divergence. Just think of it like a momentum sensor for the stock market. All it does is look at the short-term price trend versus the longer-term price trend. It's a simple way to see if the market has momentum on its side or if it's starting to lose steam. And here's a perfect visual of how it works. Using Apple stock as an example, you can see the MACD indicator there at the bottom. When that fast blue line crosses up and over the slow orange line, that's a buy signal. It suggests momentum is picking up. When it crosses back down, that's your sell signal. So we're just going to use this to be a little smarter about when we jump in and out of the market within our good 6-month window. All right, this is the moment of truth. What happens when we combine the raw power of seasonality with the timing precision of a technical trigger like the MACD? Let's pull back the curtain and look at the results of our new and improved filtered strategy. And here we go. Take a look at the new growth chart for our $1,000 investment. This time, we're only in the market during the good season and when the MACD gives us the green light. And the result? Wow, an even smoother, even steeper, and even more consistent climb to the top. So what's the final number? An absolutely jaw-dropping $189,000. That's more than double what the basic strategy gave us. Let that sink in. By adding one simple little filter, we massively boosted our returns. It just goes to show you what can happen when you combine different smart approaches. But you know, great investing isn't just about making money. It's also about not losing money. And this next chart is maybe the most important one of all. This shows what happened to your $1,000 if you were only in the market when our smart system was screaming, "Get out." This is all the financial pain and suffering that this strategy helped us avoid. And what a catastrophe it was. You would have lost almost 63% of your money. Your $1,000 would have shriveled to just $371. This shows that the strategy wasn't just about offense and scoring points. It was also about playing incredible defense and sidestepping those huge portfolio-killing bear markets. So let's wrap this up with the final hard numbers. During the bullish periods, when our system said to be in, the annualized return was 19.7%. And during the bearish periods, when we were safely on the sidelines in cash, the market actually lost an average of 2.4% per year. The numbers don't lie. This enhanced strategy is a massive upgrade. So after looking at all that, what are the big lessons here? What does this deep dive into decades of market history really teach us about how to invest our money? Let's zoom out and think about the big picture. You know, maybe the most impressive thing about this entire strategy is just how incredibly consistent it is. Look at this table of rolling 5-year returns. The takeaway is just stunning. Since 1955, there has not been a single 5-year stretch where the bad months beat the good months using our filtered method. Not once. That is some serious, rock-solid consistency. And hey, this isn't some weird fluke that only works on the Dow Jones. A very similar seasonal trend also shows up in the NASDAQ index, though its best period is a little longer, from November through June. It just goes to show that this underlying principle of seasonality is a real and powerful force that seems to affect different parts of the market. And that really brings us to our final thought for today. We live in a world that is just screaming at us 24/7 with breaking news, hot tips, and gut feelings. But this entire analysis is a powerful reminder that there is immense value in just stepping back, ignoring all that noise, and taking a long-term, data-driven approach to investing. It makes you wonder, right? What other powerful patterns are just sitting there in the data, waiting for us to find them?
So, what if I told you that inside the stock market we all watch every day, there are actually two completely different markets hiding in plain sight? Seriously. One that historically just loses money over and over again, and another that consistently, and I mean unbelievably, makes it. Today, we're going to dig into this idea of a secret barometer that might just be able to tell them apart.
All right, let's really get into this. Picture this, 2 investors. They both start out with $1,000, way back in 1933.
Both of them just put their money in the Dow Jones. Fast forward 74 years. Investor number one, well, their account has shriveled down to just $39. Ouch. But investor number two, their account has exploded to over $50,000. I mean, think about that. Same market, same starting cash, totally opposite results. So the big question is, what on earth is the difference? I mean, that's the obvious question, right? What caused this massive split? And, even more importantly, what if there was some way you could know ahead of time which one of these two markets you were stepping into on any given day? Well, that is exactly the puzzle we're putting together in this explainer.
Okay, so to get to the bottom of this, we've got to peel back the layers and look past all the daily noise. We need to find the one secret that really divides these two very different market realities.
And here's the big idea. According to our source material, the stock market is not nearly as random as a lot of people think it is. See, buried deep inside its long history are these different seasonal trends, patterns that might be caused by things like, say, big institutions rebalancing at the end of a quarter, or even just the psychology around holiday shopping. And these patterns, they've been incredibly repetitive, really consistent, in some cases for over 100 years. And here's the absolute key. They are objective. There's no guesswork. A trend is either happening or it's not. It's black and white. So to actually use this idea, the source we're looking at proposes a tool. It's called the Known Trends Index, or KTI for short. Now think of it like a daily weather report for the market's seasonal climate. It's just a simple score calculated every single trading day that counts up how many of these known positive trends are active right now.
So how does this barometer actually get built? What's going on under the hood? Let's take a look at how this KTI score actually comes together.
Building the KTI score is actually pretty simple. It's like a daily checklist. The system looks at about a dozen of these objective historical trends, and for each one that's active today, it gets a point. For instance, you've probably heard of the November to May effect, right? Well, if today's date falls in that window, boom, that's a +1 point. Certain days of the month, like the first 4 trading days, they get a point too. Even the 4-year election cycle has these predictable phases that can add to the score. And then you've got September. Historically, just a terrible month for stocks. So that's the only trend that gets a -1 point. You just add it all up, and you get this one simple number for the day. That's it, a single score that gives you a read on the seasonal weather. Okay, so we've got this daily number. Now for the fun part. Let's see how we can turn this simple score into an actual strategy, and more importantly, if it really does line up with how the market has behaved.
The whole theory here is actually beautifully simple. A low KTI score means, well, not many of those good trends are active. A high score means a whole bunch of them are firing at the same time. So the idea is that the market should do better when more of these historically positive trends are all lined up. So let's see if 74 years of data actually agrees.
All right, let's put this to the test. First up, let's isolate the absolute worst days, according to this barometer. We're talking about every single trading day since 1933 where the KTI score was 1 or lower. Now, this happened on about 21% of all trading days. So what would have happened if you were only invested on those specific days?
Well, the results are pretty rough. On days with a KTI score of 1 or less, the Dow lost money at an annualized rate of 24.5%. This is it. This is the market where that first investor we talked about ended up with just $39.
Okay, now let's flip the coin. What about the absolute best days? The days when all the seasonal winds were blowing strongly in the market's favor. We're talking about days with a KTI score of 5 or higher. Now, these are more rare. They only happen about 15% of the time. And this just perfectly illustrates the difference. On these high KTI days, the Dow gained at an absolutely spectacular annualized rate of 41.5%. The data is just crystal clear. The higher the KTI score, the better the market has performed historically. Now, that's not a guarantee for any one day, of course, but it sure does reveal a powerful long-term tendency. Okay, so this data is really interesting, right? But how could an investor actually use it? Well, the source material lays out 3 different trading models to translate this KTI score into a real strategy, and each one comes with a different level of risk.
Let's start with the simplest, most conservative approach. It's called the long-only method, and this model works the way most people think about investing. You're only ever buying. You're never selling short.
The rules here are super straightforward. If the KTI score for the day is 3 or higher, you're in the Dow. If it's 2 or lower, you're out of the market, just holding cash. That's it. No leverage, no shorting, no fancy stuff. So how did this simple filter do?
Over that 74-year test period, if you had just put $1,000 in the Dow and held on, you would have ended up with about $133,000, which, hey, not bad. But this simple long-only model, which was actually sitting in cash more than half the time, would have turned that same $1,000 into almost $2.8 million. I mean, that really shows you the power of just skipping the historically bad periods.
Okay, now let's crank things up a notch. Model 2, the long-only plus leverage method, tries to take even more advantage of those really favorable days we saw earlier.
The rules here build right on top of the first model. You're still holding the Dow when the KTI is a 3 or a 4. But now, when the KTI hits that magic number of 5 or higher, you know, those days with that insane 41.5% annualized return, you apply 2-to-1 leverage. That just means for every dollar of your own money, you borrow another dollar to invest, hoping to magnify the gains. And when the KTI is below 3, you're still sitting safely in cash.
And the result? It's just staggering. That strategic use of leverage on only the most promising 15% of days just amplifies the returns into the stratosphere. That initial $1,000 investment grows to over $116 million. This is a perfect example of the incredible power of compounding your money at a much higher rate of return over many, many decades.
And finally, we get to the most aggressive model, the one the author calls, not so humbly, Jay's Ultimate Seasonal Barometer, or JSBUS for short. Now this model, it doesn't just try to avoid the bad days, it actually tries to make money from them.
So the rules for when to be in the market are exactly the same as Model 2. But here's the big change. When that KTI score drops to 1 or less, those days with the really bad historical returns, this model sells the Dow short. That just means it's betting the market is going to go down. It only holds cash on those neutral days when the KTI is exactly 2.
And here it is, the final, almost unbelievable result from this JUSB model. By being long during the good times and short during the bad times, that same initial $1,000 hypothetically grows to over $1.5 billion. Now I know, that sounds completely insane, but it is the mathematical result of compounding an average annual return of 22.7% over 74 years, compared to just 8.1% for buy and hold.
Okay, a number like $1.5 billion. It just sounds like a fantasy. And before anyone gets carried away, this demands an immediate and very serious reality check. These are hypothetical results. They're back-tested by a computer. Following a system like this in the real world, that would take an iron will, because no system, no matter how good it looks on paper, ever goes up in a perfectly straight line, ever.
And the source material is really clear about this. The author gives a warning saying no investor should be deluded into thinking that there will never be a moment of doubt along the way. I mean, even with these incredible long-term numbers, there are going to be some very painful losing streaks.
And just to make that risk real, let's look at the JSUB model's worst ever historical performance. At one point back in 1939, this system had a drawdown of almost 37%. And get this, it happened in less than 1 month. So you have to ask yourself, could you really stick with a system after losing over 1/3 of your money in just 24 trading days? That is the real psychological challenge.
Which really brings us to the final critical question. The data we've looked at is absolutely compelling. This 74-year history suggests a powerful, persistent edge might exist. But is that history a reliable map for where we're going, or is it just a fascinating record of where we've been? Well, that is the billion-dollar question every investor has to answer for themselves.